As we look directly at the market action right now on Thursday, June 4th, 2026, Broadcom Inc. is trading live at $479.23, experiencing a sharp intraday drop of 13.78%, which translates to a decline of $66.02 from its previous levels. Seeing a powerhouse of this magnitude lose substantial ground in a single session might instantly trigger panic for anyone managing an individual brokerage account or tracking their self-investing balances. But what the broader market is completely missing right now is the sheer disconnect between this sudden price drop and the blockbuster fundamental data the company dropped less than 24 hours ago. Broadcom just delivered a masterful fiscal second quarter earnings report, showing total revenues surging 48% year over year to $22.2 billion, and posting an absolute monster of a figure in artificial intelligence semiconductor sales at $10.8 billion. Even wilder is their guidance for the upcoming third quarter, where management expects artificial intelligence revenue to skyrocket by over 200% to $16.0 billion. The stock is sliding today not because the business is failing, but because institutional traders are aggressively executing a classic sell the news strategy after an 80% run-up over the past year. The standard expectation when you look at a massive tech giant dropping double digits after an earnings report is that something must be fundamentally broken under the hood. Retail investors scanning online investing forums or checking their favorite investing sites usually assume that guidance must have missed or that profit margins are under severe pressure. The actual reality here is that Broadcom is showing some of the strongest operating leverage in the entire semiconductor universe, with a gross profit margin hitting a staggering 77% and an adjusted EBITDA margin sitting at 69%. What we are witnessing is the classic tension between near-term technical exhaustion and long-term structural dominance. If you are using the Fidelity mobile app or checking your holdings on the Interactive Brokers platform, the natural instinct today is to wonder if the top is officially in for the semiconductor trade. To understand the deeper movement, we have to look closely at trading volumes and institutional positioning over the past few sessions. The volume today is tracking well above the 20 million share daily average, proving that big institutions are actively reshuffling their portfolios. Many hedge funds and mutual funds had baked a perfect report into their models, and the moment Broadcom delivered exactly what was promised, those managers locked in profits to balance their risk exposure. This type of rotation happens all the time across major assets, whether people are actively trading Tesla stock, Apple stock, or Nvidia stock. When a company reaches a valuation above $2 trillion, it takes a massive amount of capital to move the needle, and any minor macro pressure or interest rate anxiety can cause outsized daily swings. Furthermore, this drop is creating massive ripple effects across the entire technology ecosystem, affecting automated solutions like Schwab Intelligent Portfolios and broad market index products alike. If you look at the passive side of retail wealth, individuals utilizing an automated intelligent portfolio or various retirement-focused Fidelity mutual funds are seeing their technology weightings take a temporary hit today. But looking past the daily noise reveals that Broadcom generated $10.3 billion in pure free cash flow this quarter alone, converting 46% of its revenue straight into cash. That is an almost unheard of level of efficiency for a hardware-heavy business, and it explains why the board was able to comfortably approve another 65-cent quarterly dividend, extending their streak of annual dividend increases to 16 consecutive years. For everyday traders opening their Robinhood app to check their positions or managing long-term capital through SoFi Invest, it's vital to separate short-term market mechanics from the actual cash generation power of the underlying business. Comment below how many shares of Broadcom you currently hold, or if you are looking to buy this dip. To properly contextualize how Broadcom achieved this level of dominance, we have to examine what this corporate machine actually does. Long before the current market cycle, the company established itself as the ultimate gatekeeper of modern connectivity, operating across two major business lines: semiconductor solutions and infrastructure software. Instead of focusing on consumer-facing brands, Broadcom builds the specialized mission-critical components that power enterprise data centers, networking systems, smartphones, and broadband infrastructure. When you look at their semiconductor division, they dominate the market for custom application-specific integrated circuits, Ethernet switching and routing platforms, and radio frequency chips that handle wireless device connectivity. Their business model relies heavily on long-term co-development contracts with massive cloud service providers and tech giants, meaning their revenue streams are incredibly sticky and predictable compared to traditional commodity chip makers. Over the past few years, the company drastically diversified its footprint by acquiring massive infrastructure software assets, culminating in their massive purchase of VMware. This shift allowed them to cross-sell private cloud software packages, mainframe automation tools, and cybersecurity solutions directly to the world's largest enterprises. By transitioning VMware toward a predictable subscription-based model, Broadcom effectively insulated a massive chunk of its revenue from the cyclical ups and downs that typically plague the semiconductor sector. This blend of hardware engineering and high-margin enterprise software is exactly why the company commands such a premium valuation on modern investing sites and remains a core holding inside high-end Fidelity wealth management strategies. Now, looking at the paths ahead, the true battleground for Broadcom will be defined by how reality stacks up against future market expectations. In a bullish scenario, the company continues to outpace its own aggressive guidance as major cloud data centers aggressively expand their infrastructure to support advanced computing clusters. Because Broadcom controls the premier custom silicon and high-speed switching technology required to link thousands of processing units together, they essentially collect a premium toll on every single piece of data moving through modern server networks. If they successfully transition VMware customers to higher-value cloud foundation packages faster than Wall Street anticipates, their software margins will expand even further, driving free cash flow to new records and fueling even bigger dividend hikes for investors tracking the stock through Interactive Brokers stock trading accounts or long-term Fidelity IRAs. Conversely, the bearish scenario cannot be ignored by anyone engaged in online investing or managing an individual brokerage account. The biggest near-term risk is that the capital expenditure boom among big tech companies could experience a sudden digestion phase, where hyperscalers pause their infrastructure spending to see if their massive investments are generating a real return. Additionally, because Broadcom trades at a rich forward valuation multiple, any sustained macroeconomic slowdown, sticky inflation data, or geopolitical friction affecting global supply chains could cause the stock to experience severe multiple contraction. If the broader market experiences a correction, high-flying technology names are always the first to feel the pressure as investors move capital into defensive assets. Traders managing short-term options through the Robinhood trading platform or executing active strategies via SoFi Active Investing must remain highly vigilant about these broader sector rotations. When we synthesize the core insights of this session, the contrast between expectation and reality becomes incredibly clear. The near-term market narrative expects absolute perfection, and when a stock has already climbed 80% in a year, a minor bout of institutional profit-taking can easily look like a major technical breakdown on a standard Tradle screen. But the underlying reality shows an absolute financial fortress that is beating forecasts, expanding its structural margins, and guiding for accelerating demand in its most lucrative business lines. Whether you are looking for professional investment help, building a long-term retirement nest egg using Fidelity Investments, or exploring quick swing trades on a mobile app, keeping your focus locked on structural execution rather than daily price volatility is what separates long-term success from short-term frustration. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.